Hey everybody, it's Robert Klein from Mortgage Terminator. What I'm going to do here is calculate or show you how the banks calculate what the maximum loan you can possibly have on a mortgage. So the first thing I'm going to assume, you have perfect credit. Second thing I'm going to assume, you have no other debts. Okay. So let's assume you make $60,000 a year. Based on this, what the bank will allow you to do is they'll figure out that the maximum amount you're allowed to put away in terms of a monthly payment towards a mortgage or to all of your monthly debts is 44% of your income. So if we took 60,000 times 0.44, that means $26,400 a year is allowed to go to all your payments, your monthly payments. Or divide that by 12. It's $2,200 a month. Let's move this down. Okay. Now, when you buy a property, what they're going to factor in is they're going to factor your taxes, your heat, and your strata costs. So make it very simple. If your tax is $100, you got minus $100 off your $2,200. Minus your $50 for heat. I'm assuming you're doing an apartment, and I'm going to assume $150 for strata. So what you're left with after this is, let's see, 2,200 minus 100 minus 50 minus 150. I actually do have the ability to do that in my head, but just to show it. $1,900 a month is allowed to go towards a mortgage payment. So now the next question comes up, do you want to do variable or a fixed rate? So for a fixed rate, the rate would be approximately 3.9% as an example. Your qualifying rate, if you're doing a 5-year fix, is the same thing at 3.9%. So even though your rate's 3.9, you're just going to qualify based on paying 3.9%. This will be explained more in the next option. So your max loan for $1,900 a month paying at 3.9% at 35-year amortization is, so 35 years, 1,900 payment, 0 future value, interest rate 3.9, monthly calculate present value. The maximum will be $434,000 a year. $434,000 in total value of a property you can get. Now, the next one to look at is your variable rate. So variable rate, the best rate right now is a prime minus, I think it's 0.7. So 2.5% is prime minus 0.7. You're looking at 1.8%. Now CMHC changed some rules, and they said that you no longer can qualify based on a 3.9%. You now have to qualify at today's rates at 5.79%. So even though you're only paying 1.8%, the bank wants you to qualify at 5.79. And this is only true for CMHC mortgages. Basically, the loan to value is greater than 80%, or you have down payments of 5% to, well, I guess, 20. So at 5.79%, obviously that means we can only afford a bit less. So we calculate that, and we're left with $341,000. Obviously, this is a pretty clean case. There's a lot more that goes into mortgage brokering than just that. If you have any questions, give me a call. Robert Klein, Mortgage Terminator. My number is 778-896-6732, or just Facebook me. Cheers.